Chat a little bit more about what all of this could imply. We've got Maneesh Dangi, founder, Macro Mosaic Investing and Research, joining in on the show right now. Manish, hi, morning. Good to have you on ET Now as always. Manish, pragmatic a move, much the need of the hour, this big bazooka that the Prime Minister hinted at when he spoke from the ramparts of Red Fort in New Delhi. But tell me, what is the implication of all this, both on the fisc, the macros, and of course, the obvious, the consumption boom or the fillip that it could actually entail?
Hi, Jack. Good morning to all of you. It is almost certainly should help consumption, and it's going to be. It's been about lackluster consumption. Most high frequency indicators in India had started to look like pre-COVID regime, and I think at margin, of course, last budget. Leaving some sort of money in the hands of middle class. Now this one is sort of its impact. The GST cut impact can be wider, of course, given that it touches almost all households. So at margin, of course, it should be good at private consumption. But beware of the fact that in aggregate, the demand does not improve by tax cuts if it does not coincide with higher fiscal deficit, and that is not part of the plan right now. So the aggregate demand is not what is going to get impacted. It's just that the consumption which was actually very, very lackluster, should see a spurt in demand, and particularly it's sort of well timed because it's during the festive season. It should help actually the consumption.
Right, Manish, hi, morning. You did make a very relevant point that tax cut by itself cannot lead to the spur in aggregate demand. Similarly, you've also spoken about the credit to GDP ratio and the household spending that remains lower than the pre-COVID level that we've seen. If not even this GST boost, what else is needed on this front to give a fillip to all of these factors?
So basically, in the end, a country sort of grows faster than its routine levels if there is a major investment cycle playing out either in household balance sheets or corporate. And that little bit of animal spirit is needed, that, you ought to believe that the tomorrow is going to be substantially better than what we've seen in last few sort of years. So in India, what's missing right now in substantial manner is the leverage cycle. The corporate leverage cycle, despite very, very high margins, hasn't really cranked up in a meaningful fashion. And household leverage cycle was in play until about 10 months ago, when the regulatory regime which got tightened, and of course, in general, the leverage since COVID has gone up for the household, that sort of put a dampener to the household leverage cycle. So, can government do much about it? Incrementally, government actually, to be fair, has done lots of things, and a policy easing has been in effect in India for last 8-10 months. Monetary policy has done its bit. Likely that you will see because of GST, there's going to be a 40-50 basis point of inflation cooling off, and that should actually create more space for monetary easing. The GST was much needed, and again, so all of these are incremental steps that the government can take. So you really cannot blame government for consumption slowdown. It's just that this is the way routine growth tends to be in India. And given the bad macro that we are actually living in, external macro that is, because of Trump tariffs, the growth that we're going to get at 6.5% is not necessarily a bad growth. It's fine.
Right. That's right, Manish. The macros are uncertain, but the domestic triggers are many, and at least conviction, the undertone for the market is bullish. Let's talk about your earnings view. Now, we have closed the earnings season for the quarter gone by, and it was a mixed bag, with the first half of the earnings season being weak, but the second half showing some supports to the markets. With quarter one profits up 8 to 9%, do you see FY26 earnings growth sustaining to the 8 to 10% levels?
So the broad math of an earning growth is that if it's constrained by revenue growth, and revenue growth is constrained by the nominal GDP growth of a country. So I guess, if the Indian real growth at 6%, the deflator at 2-3%, we should get 9% of nominal growth. That means 6-7% of top line growth of the revenue growth, and that in turn means only 8-9% of revenue growth. So the profit growth. And so to that extent, purely from a top-down standpoint, it seems not just this year, but even next year, the earning growth is likely at 8-9% only. And, I made this argument many times that if the nominal growth actually becomes single digit, expecting the profit growth to be 13-14% what analysts were expecting 6-8 months ago, somewhat there was a misplacement there. So I think the most analysts have actually gotten aligned to a single digit profit growth for this year. But the next year's expectations are still 15% plus. And I think, that is one bit, which will have to be recalibrated, as more data flows in. So I guess, 8-10% of the growth, as you mentioned, should be sort of in the catchment area. But, the high teen growth, which analysts are baking in for FY27, I think this is going to be a big disappointment. Purely for this quarter, actually, even though earnings have been sort of lackluster, it hasn't really disappointed analysts because the overall expectations themselves had actually come off quite substantially. So to that extent, it's met the expectation.
Sure. Maneesh, that's the domestic piece. But what about the big puzzle, which is the global piece right now? You don't have much clarity on tariffs still, while we're working with the max slab, which is a 50% tariff. It seems that the Fed cuts are likely by September, at least reading the data points and the macro indicators so far coming out of the US. But how do you think the global puzzle is actually going to pan out? And then how should Indian investors be positioned for that?
So I think you're right that I think at margin, you should see Fed easing, and that actually was a big constraint for India to ease further. September rate cut, notwithstanding high core CPI in US, is likely. And thereafter, I guess, a few more 25 whippers out there should pave way for sort of much more easing. Frankly, I think, the major view that I have, which is sort of pretty divergent from the street view in India, is that most people think either India is actually done with rate easing or we are close to end of the rate cutting cycle. And I kind of think that, whole of this year and perhaps even the first half of next year, you will see rate cuts coming in. The terminal repo rate in India is going to be substantially lower from where we are right now. And so the GST cut, Fed rate cut, all of this should pave way for, bonds to rally meaningfully more from where we are right now. But the other part of the puzzle that you mentioned, the Trump tariff, frankly, that is going to be only constrained by, how US equity does. And until US equity does decently and remain buoyant, I think, there's so much power to Mr. Trump to do anything and everything that he wishes. And so far, US equity is not misbehaving. And that actually gives him unconstrained power, so to say. I think of the 50%, 25% will go right away. But he's going to be hard negotiating. The biggest risk in India that we see, even though it's a small risk, is, if he might sort of simply, have a gaze at our IT sector. And that actually will be a very, very dangerous thing to sort of witness if it happens. I hope it doesn't happen.
So what is it all leading to, Maneesh? And you've always emphasized on the correct asset allocation. With still so many question marks at a global front, at least the domestics seem to be much under control right now, or at least the periphery that you need to work with at least seems to be much clearer. What about equity and investors? Do they put all their eggs in one basket? Do you look at just the domestics, reduce exposure to exports and global facing sectors? What do you do?
I think India will do better than US. I kind of think, and this is of course a side point, but I think the AI investing cycle, at least for near time, is actually peaking. And I think there are clear headwinds to Nasdaq given the frothy valuation it is in right now. So I would reverse the basic call that I've had for a long time that US would do better. I think India relatively would do better. India has underperformed emerging markets substantially over last 8-10 months, and there again I think the case of India underperforming at margin vis-a-vis emerging market is not there. So I think Indian equity in relative terms, relative to other equities, could actually end up doing better over next 6-12 months. I think Indian equity vis-a-vis bond is still a tough call. I think I think a 30-year bond in India at 715 actually could end up delivering better returns than equity over next 3 years. So that's because you might get substantial rate cuts and 715 go to 615, and that means you get equity-like returns there. But generally, because bonds have rallied quite a lot, the short-end bonds are very, very expensive. And to that extent, flocking to short-end bond doesn't make sense now. Okay, so all in what it means for the local investors, which is purely looking at local investing or local assets, I think a sort of a balanced portfolio would be all right. You will have to see through some volatility and sort of a meek return over next 1 year. But I guess it's not such a bad time to be sort of decently invested in India, particularly because outside things are not looking great. But you have to dampen your expectations. Returns in India are not going to be what you've seen over the last 5 years. It's going to be more like what you've seen in the last 2-3 years, sort of lowish, 10-ish return, in Indian equity.
A lot of follow-ups there then, Maneesh. First things first, what about the debt to equity ratio right now? If you were to increase allocation somewhere, what would you recommend, debt or equities?
As I said, balanced portfolio. So let's say, and then so much, Aisha, depends upon, there is no single answer. If there's a 70-year-old man that I spoke to last evening, I suggested, that, large part of his money should be simply in some of these SFBs giving 8-9% of fixed deposits. And a young kid, my boy who has just joined the job market and is actually running a firm, ideally all of his money should be in equity. So the answers are divergent for different people. But in general, I would say that relative to any time in last 1 year, you could actually think of having a decent equity allocation as well right now. But be aware of the fact that next year, 1 year is not going to be a good time for you. But you can, most people can't time market, so just do the SIP and keep entering in equity markets at different levels over the next 12 months.
Talking about your boy, I believe he's quite the prodigy. We should have him in the studios next time.
Yes, I think he deserves more than his dad, but yeah, soon there.
We'll get in touch with him soon. But so, you're saying equities will perform perhaps better depending on, your own dynamics and, what is it that you're looking out of your portfolio. And you're also saying that India is going to perform relatively better than the US, Maneesh. So what does it imply for the dollar? Is the dollar set to weaken further?
I think, basically this last 8-10 months of sort of extraordinary, and all of a sudden weakness that we saw in the dollar, I think, at margin, I think one, global risk off, and two, there is extreme positioning on the short side, actually relatively, could actually help dollar. And then if there were to be a risk off, of course, it could help dollar at margin. So dollar vis-a-vis the developed markets could actually do better. But vis-a-vis India, I think large part of losses for INR are in right now. So to that extent, I won't be too concerned purely from an INR standpoint that it will weaken substantially. So the USD INR, I think we are nearing sort of a peak, so to say. And unless, of course, something tragic happens from the Trump tariff side on Indian IT, and that is what I want to emphasize I'm most worried of. I think Indian currency will do all right.
And what about our favorite yellow metal? Um, would that continue to be as expensive as it is?
It's pretty expensive, Aisha, and frankly, and totally speculative trade now, mostly on geopolitics. I would argue. People who love gold, will not love to listen anything against it. In the end, people have to realize only one thing that gold over a very long period of time does not deliver good returns. It's done really well. It tends to be deeply cyclical. For a few years it does so well that as if nothing else can beat it, and then there are decades it does not deliver at all. And keep that in mind in allocating anything substantial to gold. Keep this basic fact in mind that it does not deliver any dividend to you. It does not deliver any gold. It's an alternate currency. And if you think that, all currencies are going to go to hell and this is why you ought to be living in something which is non-sovereign currency, which is gold, then you be in the gold. But otherwise, it's extremely expensive. And I'll actually caution investors to sort of position size in gold in a meaningful fashion.
Okay, Manish, always so good chatting with you. Thanks for your time.